Franklin India Balanced Fund. There are two ways in which investors can diversify across asset classes like equity, debt, gold, etc. when they invest via mutual funds. Choose and invest in individual funds in the proportion of asset classes matching one's risk appetite. For example, higher equity allocation if one has a higher risk appetite. Or invest in a mutual fund which offers a combination of asset classes in a single fund. For example, a single fund which invests 60% of the money in equity assets and 40% of the money in debt assets, or vice versa. Such funds are called hybrid funds. In this video, we look at hybrid funds which offer a ready-made diversified asset allocation combination to investors, thus avoiding the hassles of rebalancing asset classes on their own. Hybrid funds offer different asset classes either as a portfolio of stocks and securities or as multiple funds within a fund, called as fund of fund product in the stated proportion of asset classes. Financial prudence advocates that an investor must invest across asset classes to achieve diversification. This can be done via asset allocation. Diversification helps to lower risk in a portfolio as no two asset classes generally move up or down at the same time, and in turn aims to provide higher risk-adjusted returns. Asset allocation in a hybrid mutual fund moves as per the mandate mentioned in the offer document. One can allocate across equity and debt mutual funds manually, but this requires one to regularly monitor the allocation and rebalance it periodically to the original asset allocation. For example, if the asset allocation was a 60-40 debt-equity mix and changes to 70-30 after 1 year due to market movement, one needs to sell debt or buy more of equity to bring the ratio back to 60-40. This is called rebalancing. While rebalancing across individual mutual funds, it is also important to check for exit loads and tax implications in case of redemptions. However, in case of hybrid funds, there is no impact of exit load and tax when the fund manager rebalances the allocation. Hybrid funds offer a ready-made asset allocation combination wherein one can either choose static or range-bound asset allocation, like a balanced fund with higher allocation to equity, or monthly income plan with higher allocation to debt, dynamic or a variable asset allocation which uses a formula or strategy, like say price to earning, PE ratio, to allocate across asset classes. These funds swing between an equity orientation to a debt orientation depending upon the value of the formula. Why a combination of asset classes works? In this table, you will realize that the same asset class does not always give the best returns. Sometimes it is equity, sometimes gold, and sometimes debt. However, it is difficult to predict which asset class will do well year on year. One needs to therefore invest in a combination of all asset classes to reduce the risk of underperformance in one asset class. As per this table, a combined or a hybrid portfolio may not have provided the best returns, but has also not provided the worst returns and has stayed on a middle path. A hybrid fund thus helps to follow the middle path. What is Franklin India Balanced Fund? As the name suggests, this fund invests in both equities, minimum 50% of its assets, and fixed income, maximum 50% of its assets. As an investor, it helps you strike a balance between growth and stability by maintaining a diversified portfolio of equities to achieve growth, combined with a fixed income component to act as a cushion to the inherent volatility in equities. The equity component is invested in a diversified portfolio with predominant exposure to large-sized companies. The fixed income component of the portfolio comprises of a variety of debt instruments. Ideal investment horizon. Since the Franklin India Balanced Fund is an equity-oriented fund, we recommend an investment horizon of 5 years or more. Equity-oriented funds tend to display volatility over shorter time periods, but when one invests for longer periods of time, that volatility factor tends to get negated. Financial goals. Every investment you make must ideally be linked to a financial goal, and this goal could be of varied durations depending upon your investment needs. Since the Franklin India Balanced Fund has over 65% allocation to equities, it is ideally suited for planning for your long-term financial goals, such as higher education, for your child's marriage, a retirement corpus, or even if you're seeking long-term wealth creation. Who should invest in this fund? Those with a relatively less aggressive risk appetite. Those looking for a ready-made diversification across key asset classes. This fund can be an alternative to those planning to invest in multiple asset classes. Tax benefits. Let's take a look at the tax benefits. Liquidity. You can redeem your investments in full or in part on any business day. The redemption amount is normally dispatched within 10 working days from the date of redemption. You would receive the same either as a direct credit in your registered bank account or receive a physical check at your registered mailing address. What more do you need to know? Let's get to know some fund facts of the Franklin India Balanced Fund. For more information, please feel free to contact your mutual fund distributor or registered investment advisor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.